Okay, how to plot Elliott wave points. The first thing an Elliottician must decide is the time frame for the chart. We were just speaking about that in the previous section. You must determine first what time frame you are using. So, using minute charts, tick charts, daily charts, weekly charts, you have to determine that first because if you start trying to mix and match chart time frames, you're going to get different counts and there are going to be different perspectives. So, you could actually be in a bullish count on a smaller time frame, be it minute time frame, but being a bearish primary trend on the daily. So you don't want to necessarily focus on multiple time frames because you can get different signals, which when you're starting out can just add to the confusion. So stick to one time frame and honor that. Now, these waves are broken out into polywaves, multi-waves, and macro waves, which is just larger, more complex versions of its predecessor. We're not going to focus on that because it just adds to confusion. So we want to make sure we keep this course very clean and very to the point. So it's good to know what these terms are, the way you can talk to them, but it's not important in terms of being able to identify impulse patterns, which is what we're targeting during this course, because impulse patterns jump out off the chart and they're the easiest to identify. Okay, the one key point for how to plot Elliott wave charts is that you start the count from an important low. It does not necessarily mean the price low. Does not mean the price low. It just means the starting point of a new trend or an impulse pattern. So you may have a situation where a security may actually it may hit a certain low and not breach that low. It may take 2 months for the new trend to start and that first low holds. But that first low is not the starting point. It's the actual retracement before the explosion. So you may have a low point, have a little bounce, you pull back, maybe you retrace 61.8% or 50% of that first low, and you don't break it, but then you start the move up. You count it from the start of the move, not necessarily the price low. And again, look at these mono waves. Just really want to reiterate this. You follow the price action upward or downwards depending on the way the trend is going. Until one point is lower than the previous, there's no shift. You're still dealing with a mono wave going in a primary direction. So it is very important. You absolutely have to focus on the price data.
Wave 1 must be 161.8% of wave 5. And this again is because wave 5 is the shortest wave, and in impulse patterns, the impulse wave must be 161.8% of the shortest wave. So again, wave 1 will be 161.8% of wave 5. Now, in terms of internal relations, meaning how the waves relate to each other, if wave 3 is 38.2% of wave 1, then wave 5 will usually be 61.8% of wave 3. So you just kind of look at it, if wave 3 is a short wave relative to wave 1, then naturally wave 5 is going to be shorter than wave 3. So you kind of get this terminal pattern going where the wedge kind of, falters at the top and then it drops out. So when we look at wave 1 extensions, we have some rules which are, more subjective, meaning wave 2 cannot retrace much more than 38.2%. Wave 3 should not be more than 61.8% of wave 1. Odds are wave 2 will be more time consuming and complex than wave 4. And then the internal relationship we just spoke of. But the rules, which are ironclad rules which cannot be broken, wave 1 must be the longest wave in the impulse move. Must be. Wave 5 must be the shortest of the 3 thrust waves. and wave 1 must be 161.8% of wave 5. So no matter what, if you can just stick to those three things and respect those three rules, you will be able to properly identify a wave 1 extension. Okay, how to identify a wave 1 extension. So we were speaking to it earlier, when you have that first wave up, it creates that kind of running into the pattern when you get that very strong wave. So you're going to develop a wedge pattern, as you can see here. Wave 3 is going to be, of course, shorter than wave 1, and then wave 5 is going to be shorter than wave 3. So you're going to get this kind of topping effect. So the upper trend line is drawn across wave 1 and wave 3. The support or bottom trend line is drawn from wave 2 to wave 4. So if you have a terminal wave 5 and a first wave extension, it won't touch the top of this trend line, fall, and break down. If you have a wave 5 that has a little strength to it, then it may come out of this resistance line a tad, but it of course will roll. So again, wave 1 extensions, wave 1 must be the longest wave. Wave 5 must be the shortest wave. And wave 1 must be 161.8% of wave 5. And if those three things are present, you're going to develop this kind of wedge pattern. Okay, let's take a real-life wave 1 extension example. Now, I chose this one. This is ticker ZUMZ. I chose this ticker because it looks like a wave 1 extension, but it's actually not. And that's why I picked this one out. Now, wave 1 is the longest wave. As you can see, fits that requirement. Wave 5 is the shortest wave. As you can see, wave 5 is 18.74. Wave 3 is 22.65. And wave 1 is 28.6. So wave 5 is the smallest wave. But where this pattern fails, our three mandatory rules for wave 1 extensions is that it is not, wave 1 is not 161.8% greater than wave 5. So if you take wave 5, you take 18.74 times 1.618, you get 30.32. 30.32. As you can see, wave 1 is only 28.6, so it does not meet our requirement. Now this is where it gets fun. Now look at this. This is exactly what we just talked about. You got the first wave coming in really strongly, third wave, and wave 1 and wave 3 create this kind of wedge pattern up top. 2 and 4 connect. 5 comes out the top just a tad and fails. And look at this breakdown. You go from basically, $53.99 down to $5 in about a year. Now that's a breakdown, and one can argue that was a wave 1 extension that completed the pattern and failed. And you know what? You're probably right. But we have to honor the rules. And the reason you honor the rules is because it limits the scope of the securities you can monitor. If you start to make the rules lax, you have no way of gauging one trade to the next because you're bending the rules. And lastly, it opens up the window of potential trades. So you want to limit everything. You want to limit the amount of securities you can trade, as well as focus in on the rules. That way you can compare trade to trade. You're never comparing apples to oranges. So again, this is something where you have to really look at the numbers closely, because while this looks like a first wave extension, it is not.